Hello, I'm D. Marcus Garrett, and on this channel, I help you learn more, earn more, and save more. I asked some of my guest experts how they would build wealth during a stock market crash. The millionaire founder behind Personal Finance Club and the course How to Build Wealth with Index Funds, Jeremy Snyder.
So your course and platform is how to build wealth by investing in index funds. So why index funds?
That's a great story. Thanks for opening that account and saying it, because the world of investing is a scary place the first time you dip your toe in it. If you walk in and you hear about investing, there's images of people on the traders on the floor of the stock exchange frantically waving pieces of paper, and Bitcoin and oil futures and pork bellies and day forex and day trading. It's crazy, but at the end of the day, almost all that is total nonsense. If you read all the classic books on investing and really understand how to build wealth in this world, it's by buying the companies of the world that generate the profits of the world and owning them so that you get your share of those companies. And then, the question is okay, well, which companies to buy? And the answer ends up, after some research, it ends up being pretty simple, which is, the market is efficient, which means all the sum total of human knowledge is priced into each and every stock in the stock market. And so a single person, me, anyone, professionals can't look at the stock market and decide which one to pick. So enter the index fund. It's just a simple, low-cost way to buy all the stocks, which on first glance, the first time you're hearing it, sounds a little crazy. But when you own all the stocks, you've guaranteed yourself your fair share of all market growth. Every single worker, from the janitors to the CEOs, is working to make you rich, and as those companies grow in profit, those profits are funneled back to you. And so what you did by opening a Vanguard account, putting it into a low-cost index fund, and just leaving it there, you saw going from 1,000 to 1,100 isn't going to change your life. It's a free $100, but that 10% rate of return, which is about it's what's called the compound annual growth rate over the last 100 years of the stock market. If you put $250 a month away over the course of 40 years, that's over $1 million. And if you want to get there faster, you put more than $250 in.
Yes, sir. And you talked about some of your classic reads. I read, so I'm an auditor by trade, so I always got to follow the data. I don't feel comfortable just, acting on my own, taking a lot of risks. And so I read 15 personal finance books. My top two favorite right now are The Millionaire Next Door, because that's a book that my father gave me in high school.
Love it.
So I kind of just have some emotional attachment to it. But my new favorite book is A Simple Path to Wealth. Do you have a book that you would recommend for people to read?
Those are two of my favorite ones too. I have a reading list on my website. I actually, thankfully, read The Simple Path to Wealth relatively recently, and I say thankfully because if I had read it years ago, I would have felt like a total fraud, because he basically says the exact same thing I say, and it makes sense because we're both big fans of Jack Bogle, who is the founder of Vanguard. Those I think those are two really good ones, because The Millionaire Next Door talks about being frugal and living below your means, and how I'm a millionaire. I drive a 2016 Mazda. It's not about showing your wealth. It's about spending less and investing to actually have wealth and not look wealthy. Another one that I think anything by Jack Bogle, the little book of Common Sense Investing, which basically talks about index funds. There's one that I like. It's called A Beginner's Guide to Investing, which is 100-page. It's kind of the cliff notes of all the classics. I like A Random Walk Down Wall Street. All these say the same thing, which is anytime people start to want to be smart and try to pick and choose stocks or day trade or get into some more speculative form of gambling in the market, it's not good. It's not likely to have you beat the market. It's more likely to have you lose the market.
Next, I asked Eric Brotman how he would invest during a market crash. Eric has over 20 years of experience, is a certified financial planner, AEP CPWA financial advisor, wealth manager, mentor, host, and author of Don't Retire, Graduate. And we're back. Still in the sophomore year, had to pay some bills around here. Thank you for continuing to tune in. And we are at financial independence, something I know many of you know and love, I should say. And the one that I want to call out here is the art of portfolio design. So we've already talked about children, those little crumb snatchers snatching away at our wealth management. So how do we get our art of portfolio design to account for these factors in our lives?
Well, I think the first thing is to understand that some of the rules of thumb that we've been, if not taught, we've been subjected to over the years of our lives aren't necessarily, they don't necessarily fit. I say one size doesn't fit all about so many things. This is another one. your portfolio needs to include different elements based on your life, your income needs, your tax bracket. It's not just about picking the right growth fund or the right value fund or the right manager. It's really about asset classes, and it starts there. And there are folks who would say that you start with an equity portfolio, and you have a real estate portfolio, and you have business interests, and there are lots of different ways to build wealth. But from a purely investment portfolio standpoint, there are only three traditional asset classes that are included in most indices. It's stocks, bonds, and cash. And we're at a point in the world where equities look expensive. I don't know whether they'll prove to be or not, and I have no crystal ball either, so I'm not predicting the future either. But there are indications that particularly U.S. equities could be expensive. Bonds are in harm's way. I mean, bonds did so well for so long because interest rates just kept dropping and dropping and dropping. And now we're seeing inflation. We're seeing inflation impact that. We're seeing interest rates rise. That's going to hurt bond prices. And you still can't get a decent yield in most bonds. And then cash is paying nothing. So that your traditional asset classes can't by themselves do the job. Because if you're a senior, you've already ideally positioned yourself to create income. You've already positioned yourself to avoid unnecessary market risk. And if you're a young person, bring on the market risk. Let's grow this thing. But if you're in between, those are the folks who got crushed. That's part of the reason why after the great financial crisis, people had to work longer. They had to work 5 extra years just to make up for lost time, which meant there was no job turnover, which meant there weren't new jobs for millennials. And it like snowballed in the economy because of this event. There's to me, there are 3 different primary strategies for creating income. And, I detail them in the book, but functionally it's a total return strategy, an asset segregation strategy, and an annuitization strategy. And they're all different, and they all can be used interchangeably for different households, for different situations based on age and health and marital status and so forth. One size never fits all. Well, if you're talking 25 times, and I don't know that reference, but if you're talking 25 times, that means a 4% withdrawal rate, 4% being the rule of thumb.
Yep.
But we've talked about rules of thumb. 4% works great until it doesn't. All right. And if you happen to be one of those unfortunate souls who retires, or whether you've quit your job or whether you believe you're coasting and it's 2007, 4% is going to look a whole lot different after market corrections or economic changes. It's really also not about just 4%. It's got to be 4% net of expenses. And ideally, it needs to also keep up with inflation. So if inflation's 2%, and you're pulling, and you need to earn 6% on your portfolio. If inflation's 2%, for you to live on 4% and still maintain your standard of living, maintain your dignity. If inflation is suddenly 6%, then you suddenly need a 10% return to take a 4% withdrawal. I don't know where you're going to find that, but you can manage my money if you promise you will.
Finally, I asked Terry Igeomo, the founder of Trade and Travel, a course that has sold over 40 million on Teachable. Here's what she had to say about investing during a stock market crash.
You know what? I am so glad that I actually went to MIT. That was so out of my comfort zone growing up. I had actually wanted to go to University of Texas. I had already gotten a scholarship to be the team captain of the basketball team. It was close to home. I have some friends and family in Austin. So that actually was my real dream. But when I got accepted to MIT, all of my counselors and teachers were like, no, you've got to go. And that changed the trajectory of my life. I'm so glad that I actually went out of the state. Most of my friends from home, they actually stayed closer to home, but went out of state. I had a full scholarship to MIT, so I got to study abroad my last semester. They actually had money, so I was the captain of the STEP team. I was the captain or the president of Office of Minority Education, student services, like all these things because they had money to pour into us. And I can't imagine having any other experience, but I didn't grow up with all of that. Like you said, I had a mom and a grandmother, and things were pretty simple. Life was just whatever we could afford, we just made it happen. So my personal opinion is if you're ready to learn how to trade, you can still learn now. Like even like start the class, start studying, start learning how to make your money grow. Because honestly, you learn more than just how to make your money grow. You also learn a lot about yourself as a trader. Your mindset is a huge thing. Do you have discipline to stick with a trading plan? What happens when you're losing? How do you respond? When you're winning, do you have the courage to actually take your profit? Like all those things are mental things that you improve as well as a trader. So if you're just learning the skill set and trading in your sim account or with the paper money, as we talked about, you don't have to have all your debt paid off. And then the same thing with salary. I know a lot of people who lost their job during COVID and then picked up the skill of trading, and then they started trading their retirement accounts. So they had moved some money from their old jobs into a self-directed IRA, and then not all of it, but they would take a little bit of that and then see if they could make it grow as they were learning to be a better trader. So salary also doesn't matter as much. I think the bigger thing is, are you ready to really be consistent or like really learn a new skill? And then, like, while you're in your sim, you can get your money right in other places.
That was actually newer for me. We had a conversation with Innovative Wealth. I told you I name drop folks. Kirk Chisholm, if you want to find that on the channel, youtube.com/TheMarcusGarrett. And he talked about investing within your retirement account as well. That's going to be a new concept for a lot of people. A lot of people didn't even know that is possible. So can you expand on that a little bit? Because what I think people are going to interpret that is, and I don't blame them, is taking my money out of my retirement account, which you should not do, and is not what we're saying. And then I think it's paying like 20% and an early withdrawal fee on it. So you're working with like 70, if you're lucky, percent of your money, probably closer to 15 to 19%. That's not what we're saying. So can you expand a little bit on what that is as far as self-directed investments for a retirement account?
Sure. So let me use my personal story. I was working in education, and I decided in October of the school year that I wanted to leave. And if anybody else knows like school year calendar, that's like 1 month in, I'm ready to go. But I didn't leave until the end of the year. So what I did is I went to all of my old accounts that I had just sitting for. I worked in nonprofits and regular, so like old 401ks, old 403bs that were just sitting, and I moved them into a self-directed IRA. And a self-directed IRA means that I could invest in individual stocks, but it was still in a retirement account. So I didn't have to pay taxes on it as long as I moved it over in a timely fashion to my self-directed IRA. Then that whole school year, while I was practicing, I traded that money. Now, somebody might say, well, no, you're not supposed to touch your own retirement. And I get it. It was a personal choice. If I could make that money grow, then I could leave my job. And that was more important to me than letting the money just kind of grow on its own in the retirement account. So that was a personal decision. And then also I had about 35,000 in there. My goal was to make $300 per day. If I could just, which is 1%, about 1% of that account. If I could just make $300 per day, I could replace my income as an assistant principal. So I wasn't trying to knock the ball out the park. I wasn't trying to double my money in 2 days. It was like, no, I just need 1% return on a regular basis so that I don't have to talk to this boss or see these crazy people one more day. So that's my personal story of how I moved it over. And then when I did become good, when I was starting to see those consistent $300 a day, that's when I did move the money into a cash account. And yes, I took a penalty on it, but I at that time knew that I could make more than 10%, which was the penalty that I had to pay on it. So at that point, it was like, okay, I've proven myself. I know that I can make more than the penalty, and I'm okay with that.
For the full interview behind all of these clips, find a link in your video description below, and for a video response, drop your questions. Thanks for the follow.